3 days before SpaceX started trading, Harvard Law's corporate governance blog published an analysis titled Top IPO, Weak Governance. Here's the specific clause in SpaceX's charter that almost nobody covered before the shares went live. Harvard Law's corporate governance blog doesn't write about IPOs for sport. When it called SpaceX's governance structure weak 3 days before the stock went live, it was looking at something specific. Let's go through it clause by clause. SpaceX has 2 share classes. Class A is what you can buy at $135, 1 vote per share. Class B is what Musk holds, 10 votes per share. He owns 42% of the economic value of SpaceX and controls approximately 85% of the voting power. Those 2 numbers sitting next to each other tell you who this company answers to. Here's what the voting math produces in practice. There is a CEO removal mechanism written into SpaceX's charter. It requires a majority vote of Class B shareholders. Musk holds 93.6% of Class B. Triggering that mechanism requires him to vote against himself. That has never happened. In any structural sense, it cannot happen. The board can recommend. Institutional shareholders can protest. None of it moves without his vote. That's not a flaw in enforcement, it's the design. Under Texas law, SpaceX has classified itself as a controlled company. That exemption removes the requirement for a majority independent board and eliminates independent oversight of nominations and executive compensation. Meta, Google, and Snap use the same structure. SpaceX raised $85 billion at a $1.75 trillion valuation with this already locked in. Public shareholders knew the terms going in. The deal was 4x oversubscribed. The market priced the governance risk and bought anyway. Now here's the clause that got almost no coverage before the IPO, the Corporate Opportunities Clause. SpaceX's charter grants board members, including those who simultaneously sit on the boards of Tesla, xAI, the Boring Company, Neuralink, and X, the legal right to redirect business opportunities away from SpaceX to those other companies first. This is common in complex corporate groups. What isn't common is one person running all of them simultaneously, while SpaceX's largest single customer is the US federal government. Dual-class structures are not new. Investors accept them for high-conviction founders with long-horizon missions. The SpaceX-specific layer is the combination. The Corporate Opportunities Clause, running alongside 7 concurrent Musk entities. With the federal government sitting at the top of the revenue stack, each element alone is manageable. Together, they create a conflict of interest surface that no comparable public company has tested at this scale. The governance critique isn't that the structure is illegal, it's that it's permanent. You can't vote him out. You price that in at $135 a share. Whether that's a feature or a bug depends entirely on your thesis for what SpaceX becomes over the next 20 years. If you're buying SpaceX shares, you're not buying a stake in a company with conventional accountability mechanisms. You're buying a long bet on one person's decision-making staying correct across 7 companies, a government contract book, and a decade-long mission timeline. Next video covers the specific federal revenue lines SpaceX depends on and what a political shift does to the balance sheet. Follow if you want the next one when it